Welcome back to the Deep Dive. Today, we are taking a really extensive look at the central institutions that form the absolute foundational infrastructure of global finance. We're talking about the stock exchange operators.
That's right. Companies like the NYSE, NASDAQ, CME Group, LSEG, these are the publicly traded entities that are, well, they're essentially the technology-driven superhighway for finance. Trillions in securities, trading, clearing, and settlement happen on their platforms every single business day.
And for investors, this sector it's quite unique, isn't it?
It really is. It's an investment class defined by, incredibly high barriers to entry, immense cash flow generation, and what you can only really describe as an oligopolistic market structure. Our mission today is to give you a shortcut, sort of, to understanding the big strategic transformation that's underway.
Right, specifically that critical shift they're making, moving away from relying so much on volatile transaction fees.
Exactly. And moving towards generating high-margin, recurring revenue from data and technology. That's the key trend.
So we're going to analyze the key players, look at their specific competitive positions, and try to understand why the market assigns such, well, wildly different valuations to companies that, on the surface, seem to do a very similar job.
Okay, so to set the stage, let's start with two distinct ways of viewing this market. The first is looking at the underlying value of the assets being traded.
And when you look at just the raw scale, particularly the cash equity markets, North America is just the undisputed leader.
Absolutely.
Driven by the companies listed on the NYSE and NASDAQ, that region represents roughly, $54 trillion in listed securities?
Yeah, around that mark, about $54 trillion.
That accounts for something like 60% of the entire global equity market caps. It's a staggering number, really speaks to the capital concentration in the U.S.
That scale is absolutely crucial context. But here's the first major insight, the thing that changes everything for an investor looking at these companies. If you look at the second view, the actual market capitalization of the companies that operate these venues.
Ah, the operator themselves?
Right. The hierarchy is completely inverted. The size of the underlying market, it turns out, does not dictate the value of the operator running it.
And that's the valuation disconnect. It's really striking when you see it. Logically, you'd think the owner of the world's largest cash equity market, the NYSE, should be the most valuable exchange operator, right?
You'd think so. But the financial data, well, it tells a very different story.
Yeah.
As of October 2025, the world's most valuable exchange operator is actually the CME Group.
CME?
Yep, with a market cap approaching $98 billion.
Wow.
Intercontinental Exchange, or ICA, they own the New York Stock Exchange. They're a close second at around $90 billion.
Okay.
But contrast that with NASDAQ. They run a huge chunk of that $54 trillion U.S. market, but their valuation is considerably lower, around $51 billion.
So there it is, the great disconnect. The underlying size of the cash equity market is just decisively outranked by the valuation of the derivatives-focused specialist, CME, which leads us directly to that aha moment, as you called it. Why? Why does the market assign such a massive premium to CME Group? Their core focus isn't cash stocks, it's derivatives.
Right. And the aha is that the derivatives business model is, frankly, financially superior in many ways. It offers extremely high operating leverage and, crucially, a mandatory utility. CME's revenue stream is dominated by futures and options across critical global segments: interest rates, equity indexes, foreign exchange FX, and commodities.
And these products, they aren't just for speculation, are they? They're essential tools for managing systemic risk.
That's precisely the point. They are mandatory tools. Every major financial institution, every corporate treasury managing currency risk, every central bank setting policy, they rely on these tools, hedging interest rate risk, commodity price swings, currency exposure.
So if you're running, say, a $50 billion bond portfolio.
You are absolutely using futures contracts to hedge interest rate movements. You simply have to. It's not optional for prudent risk management.
And when we talk interest rate futures, the global benchmark is CME's offering on SOFR, right? The Secured Overnight Financing Rate.
Yes, which replaced LIBOR. Their dominance in SOFR futures makes them the absolute epicenter of global interest rate risk management. It's hard to overstate its importance.
Okay, so that mandatory nature is clear. What about the operating leverage you mentioned?
Right, the leverage. An exchange operator's costs, think the technology, the massive data centers, the core infrastructure, they're largely fixed.
Right. Doesn't cost much more to process one extra trade.
Exactly. The marginal cost of processing one additional futures contract is near zero. So when market activity increases, or importantly, when volatility spikes,
Yeah.
which drastically increases the need for hedging, that incremental revenue flows almost entirely to the bottom line.
Mm.
It's a tremendously profitable setup when volumes rise.
So, unlike cash equity markets, which can be pretty sensitive to, say, retail trading sentiment or just quiet periods in the market.
The derivatives business benefits structurally from broad, global macroeconomic trends and, crucially, from uncertainty and volatility.
Okay.
When there's geopolitical tension, like we saw recently, or when central banks are actively adjusting policy or just general market jitters the demand for hedging spikes
Which drives up CME's transaction volumes.
directly, reinforcing their revenue stream precisely when other parts of the market might be flagging. They're essentially a risk management utility whose profitability is partially indexed to global uncertainty. That's a very, very powerful position to be in.
And the market clearly values that resilience and stability far more than just the sheer volume of assets listed on a cash equity exchange.
That's what the valuation premium tells us, yes.
That inherent utility, that sort of benefit from chaos, brings us to stability. How do they protect this incredibly profitable position from competition? That must be where the economic moat comes in.
Precisely. The term economic moat, which Warren Buffett popularized, just refers to a company's sustainable competitive advantage, the thing that protects its long-term profits. And exchange operators, they possess some of the widest, most resilient moats in the entire financial sector. It's why the industry is basically an entrenched oligopoly. Barriers to entry are extremely high.
Okay, so what are those primary structural barriers? What keeps new competitors out?
You can think of the moat as having maybe 5 critical layers, but the single most important one, network effects.
Right. Liquidity breeds liquidity.
It's self-reinforcing liquidity, exactly. A marketplace's value to any one user is directly proportional to the number of other users on that platform. Traders and companies issuing stock, they naturally seek the deepest, most liquid pools of capital,
And that existing liquidity just attracts more participants.
which deepens the pool further, making it harder and harder for anyone else to catch up.
You can't just launch a new venue and, declare we have liquidity now.
No way. Liquidity is earned. It takes decades to build. A startup exchange simply cannot conjure up the billions in daily order flow needed to compete with incumbents who benefit from decades of established relationships, trust, and deep technological integration. That feedback loop is nearly unbreakable.
Okay, network effect is number one. What's next? Regulation.
The second barrier, absolutely, is the massive regulatory hurdles. These operators are designated as critical financial infrastructure. Getting the necessary licenses to operate a major exchange, or importantly, a clearinghouse, from bodies like the US SEC or Europe's ESMA.
It's a long, painful process, I imagine.
Long, arduous, multi-year, and involves immense capital commitment up front. The ongoing regulatory burden and the sheer cost of compliance function almost like an automatic competitive filter. It weeds out those who can't afford it.
But wait, isn't that a bit of a dangerous argument for an investor? Relying on bureaucracy. What if a government, maybe wanting to boost competition, decides to simplify those regulations? Is that a risk?
That's a fair challenge, yeah. And simplification isn't impossible, theoretically. But the complexity is now so deeply baked into the global system, largely due to cross-border risk management and systemic stability concerns post-2008. Regulators everywhere are primarily focused on preventing the next crisis. So any regulatory changes we see tend to actually add operational resilience requirements, things like data redundancy, stricter cybersecurity protocols.
Which cost even more money.
Exactly, which inherently raise the capital barrier even further. It's less about simple red tape and more about guaranteeing the lights stay on globally during a major market shock. That costs money.
Which makes the cost of the technology itself another huge barrier.
That's the third layer, high capital and technology costs. We're talking continuous, massive global investment. Secure, low-latency trading infrastructure is incredibly expensive. Proprietary algorithms, advanced global data centers, military-grade cybersecurity defenses.
Constantly needing upgrades, too.
Constantly. The cost of just running and upgrading this infrastructure, just to keep pace with technology and threats, is staggering. It easily prices out potential new entrants.
We also shouldn't ignore just the sheer weight of history and, well, reliability.
Definitely not. That's the fourth component. Intangible assets and trust. The NYSE, founded 1792. These institutions have survived financial panics, world wars, massive technological shifts. That accumulated brand equity and institutional trust. It's priceless in finance. For a fiduciary managing other people's money, choosing the venue with the longest track record of safety and reliability isn't just preferable, it's arguably part of their risk management duty.
And finally, number 5, once you're plugged into their system, it's incredibly hard to leave, right? The switching costs.
Exactly. The fifth mode element, high switching costs. Just imagine a major global bank trying to fully disentangle itself. Decades of custom-built proprietary software, data infrastructure, compliance protocols baked into their systems, clearing operations, all tied into an established ecosystem like ICE or CME.
The operational headache alone.
It's prohibitive. The cost, the legal risk, the sheer operational disruption of migrating all of that successfully. They are technologically and contractually locked in many ways.
So you've got this environment where the biggest barrier is almost the customers themselves, reinforced by regulators and the high cost of tech. That paints a picture of extreme structural resilience. But as you mentioned earlier, these giants realized that relying only on transaction volume wasn't stable enough. That prompted this massive strategic pivot.
Right. And that transition is really the defining story of this sector over the last, say, 2 decades. After demutualization, when these firms went from member-owned clubs to for-profit, publicly traded companies, they realized that transaction fees, while great during high volatility, are just too cyclical. Too volatile for a public company that needs to show steady earnings growth quarter after quarter.
They needed to move away from that unpredictable flow-based model.
Towards a more stable, predictable subscription model.
Yeah. Okay, let's detail the 4 main revenue streams and see how that mix has shifted over time.
Sure. The oldest stream, the original business, is trading, clearing, and settlement. This is the core transactional revenue. Highly profitable when markets are busy, but, as we said, highly volatile. When market volumes are robust, this segment booms. When the market goes quiet, it can slow down very quickly.
Then you have what sounds like the most reliable, but maybe not the most exciting segment.
That would be listing and issuer services. Companies pay annual fees to maintain their listing status on the exchange. It's stable, predictable income, absolutely. But its proportional contribution to the total revenue pie has been shrinking pretty rapidly.
Oh, really?
Yeah, data shows it fell from representing about 14% of total industry revenue back in 2004 to just 8% only a decade later. It's a solid anchor financially, but it's definitely not the growth engine anymore.
Okay, that brings us to the 2 segments the market is really focused on now and rewarding. Let's start with the big strategic focus data.
Right. The most important strategic segment now is market data and analytics. This is the holy grail. High margin, recurring, subscription-based revenue. It comes from selling real-time trade data feeds, historical depth of book data, proprietary indices. Think about index licensing.
Like the FTSE Russell indices.
Exactly. LSEG owns FTSE Russell. Fund managers pay LSEG significant licensing fees just to use those indices as benchmarks for literally trillions of dollars in passive funds and ETFs.
And this data is monetized how? Through terminal subscriptions like Bloomberg or Refinitiv Icon, institutional data feeds.
All of the above. Terminal subscriptions, direct data feeds to institutions, licensing fees for index tracking products, analytical tools built on the data. It's become an essential utility. Price elasticity is relatively low because, frankly, you cannot run a modern trading desk or compliance department without the official exchange data.
Okay, essential data. And the 4th stream?
The 4th is technology and software services. This involves the exchanges licensing their own proprietary trading systems, surveillance software, and clearing platforms to other financial firms globally, brokers, smaller exchanges, banks.
So they're selling their tech expertise.
They are. And a lucrative part of this is offering co-location services.
Ah, co-location. That's where firms pay a hefty premium just to put their servers right inside the exchange's data center, isn't it? For speed.
Precisely. To achieve the lowest possible latency, measured in microseconds, for high-frequency trading strategies. It's essentially pure technology rent paid by the fastest, most sophisticated market participants.
So the overall goal of this whole pivot, get more revenue from data and tech.
The goal is to have, ideally, maybe 50% to 70% or even more of total revenue coming from these non-transactional, recurring, high-margin subscription sources. Data, analytics, tech services, index licensing. That's the target state.
And the poster child for this radical transformation, the clearest example, has got to be the London Stock Exchange Group, LSEG, right? The scale of their move was just enormous.
Absolutely. The LSEG case study is the clearest, most dramatic evidence of this strategic pivot being a necessity, not just a choice. Their massive $27 billion acquisition of the data provider Refinitiv. It was designed to instantly transform their identity.
Before Refinitiv, LSEG was seen as, a venerable, important, but primarily European exchange operator, London, Milan.
Exactly. After the deal closed, LSEG instantly became a global data giant. Competing head-to-head with the likes of Bloomberg and FactSet, they acquired Refinitiv's immense data distribution network, the Icon financial terminal platform, which serves hundreds of thousands of finance professionals worldwide, plus a massive portfolio of historical data, analytics tools, risk management solutions.
It just instantly flipped their revenue profile.
Completely. It made them heavily data-centric overnight, aiming for that resilient, predictable earnings stream, regardless of whether daily trading volumes on the London Stock Exchange or ETHRA are up or down.
That move really makes them look less like a traditional market operator and much more like a fintech data utility company.
That's the goal.
Which, as you said, the market generally rewards with higher valuations because of that stability and predictable growth.
Precisely. They are deliberately trading the potential, high spikes you get from trading volatility for the perceived certainty of a high-margin recurring subscription model. This kind of strategic move is almost mandatory now to offset some of the structural headwinds they all face.
Okay, let's turn our attention to those headwinds then, because having strong moats doesn't mean the sector is completely risk-free.
Not at all.
We touched on the regulatory paradox earlier, how it kind of hinders and helps them at the same time. Can you elaborate on that a bit?
Sure. The paradox is pretty simple, really. Increased regulatory scrutiny definitely creates more compliance work, more cost, more burden. But that very burden tends to strengthen the incumbents. Take, for example, the EU's DORA, the Digital Operational Resilience Act. It mandates extremely stringent requirements for operational stability, cybersecurity, disaster recovery for all critical financial entities.
So if you're a small competitor, maybe trying to launch a new exchange or trading platform, DORA basically says you have to invest huge amounts of capital in redundant systems, data recovery sites, constant penetration testing, just to be allowed to operate.
Exactly. It raises that capital hurdle so incredibly high that potential new challengers often just cannot afford the continuous, massive investment required to meet the standards regulators now set for ensuring systemic stability. Remember, in the wake of any major financial crisis, the public understandably demands safer, more resilient infrastructure. The major exchanges are seen as providing that safety net, and regulators inadvertently reinforce their dominant position by demanding ever greater and costlier resilience from everyone.
Okay, so regulation is a double-edged sword that mostly cuts in their favor. What about external pressures? Geopolitical volatility has been pretty intense, especially looking back at late 2025.
Yeah, geopolitical risk directly impacts market stability and therefore exchange revenues, but in different ways. We saw this clearly with those late 2025 threats of escalating U.S.-China trade tariffs. That uncertainty caused sharp single-day sell-offs, remember? S&P 500 down 2.7%, NASDAQ down 3.6% on one day. Now, obviously, those kinds of events cause temporary pain in the equity markets.
Right.
But the resulting uncertainty, that's pure revenue fuel for the derivatives exchanges.
Because institutions rush to hedge their portfolios against all that unknown risk.
Precisely. The need for risk management tools, futures, options, other hedging instruments, it spikes during periods of instability. So while cash market sentiment might suffer, that volatility provides an immediate, strong, counter-cyclical benefit to the derivatives segments of CME and IC. Volatility for those specific business models is actually a feature, not a bug.
Interesting. Okay, now let's tackle the competition that tries to fragment the market structure itself, the rise of dark pools and these alternative trading venues. This feels like maybe the most direct threat to the core business model of NYSE and NASDAQ, doesn't it?
It is a critical challenge, no doubt. The U.S. market structure in particular is highly fragmented. You've got around, 59 distinct execution venues now, including over 37 alternative trading systems, or ATSs, many of which operate as dark pools.
And the data on volume is pretty stark.
It is. By January 2025, we saw that a slight majority, actually over 50%, of all U.S. stock trading volume was executing off exchange in these dark pools and broker-dealer internalizers.
Wow, over half. That sounds like fragmentation is seriously undermining the core transaction fee revenue of the public lit exchanges.
It certainly puts immense pressure on their pricing power for basic execution, absolutely. But, and this is the crucial distinction, you really need to understand, dark pools are fundamentally, They're parasitic.
Parasitic, how so?
They're not true market centers in the sense of price discovery. They are primarily execution venues. They don't determine the price of a stock.
Right, they execute trades based on prices set elsewhere.
Exactly. Dark pools typically operate by executing trades, often at the midpoint of the NBBO, the national best bid and offer. And where does the NBBO come from?
It comes from the transparent order books of the public, the lit exchanges, NYSE, NASDAQ, SIBO.
Precisely. The NBBO, the best available price across all those lit venues, is determined exclusively by the price discovery happening on those transparent public exchanges.
So the dark pools rely entirely on the price discovery function of the very exchanges whose liquidity they might be fragmenting. It's kind of ironic.
It is. If everyone traded only in the dark, price discovery would completely collapse. There'd be no reliable price signal. So yes, this fragmentation definitely limits the transaction revenue that NYSE and NASDAQ can capture from every single trade. But importantly, it powerfully reinforces the strategic value of the exchange's high-margin market data businesses.
Ah, because everyone, including the dark pools, needs that official price feed.
They remain the source of truth for pricing. And everyone, including the dark pools, the high-frequency traders, the institutions, must pay the exchanges for that critical data feed. So the pivot to data looks even smarter in this context.
That feeds right back into the strategic pivot again. Okay, let's touch on a couple of other long-term structural shifts. What about passive investing, the rise of index funds and ETFs?
Yeah, that's a huge multi-decade trend. The shift towards index funds and ETFs means a significant and growing amount of capital is now managed passively, and passive management generally results in much lower portfolio turnover.
Less buying and selling compared to active managers trying to beat the market.
Right, less frequent trading overall. And that inherently exerts long-term downward pressure on transactional volumes across the board for everyone. This structural reality just makes that pivot towards stable data revenue, index licensing revenue, like LTHIG owning the FTSE Russell franchise, not just a good idea, but really a strategic imperative for long-term growth.
Makes sense. And finally, what about the disruption narrative around blockchain and cryptocurrency? Is the old centralized exchange model truly under threat from decentralization?
Well, the trajectory so far suggests it's more about co-option and leveraging regulation, rather than wholesale disruption of the incumbents. The established players aren't really fighting the digital asset world. They seem to be strategically integrating it on their own terms.
Oh, so?
Well, look at CME Group. They're now a leading global venue for regulated cryptocurrency derivatives. Offering futures and options on assets like Solana and XRP, they're leveraging their existing trusted clearing infrastructure and their relationships with institutions to offer regulated access to this new asset class.
So, by acting as the regulated gateway, they maintain control over the institutional flow into crypto.
That seems to be the strategy. ICE, similarly, made investments in the crypto-adjacent poly-market platform, showing they're exploring these concepts, but often through traditional investment vehicles or partnerships. And perhaps most significantly, the SEC's approval of spot Bitcoin ETFs earlier this year further integrates crypto into the traditional ecosystem, because where do those ETFs primarily list and trade?
On the established exchanges, NASDAQ, NYSE, SIBO.
Exactly. So they're taking what could have been seen as a potential threat and are actively turning it into a new, regulated growth vector for listings and trading volume.
Okay, that's a really comprehensive view of the strategic landscape, the moats, the headwinds, the pivot. It really sets us up perfectly to differentiate the major players now, because as you said, they are not interchangeable at all.
Not at all. Their individual strategies, often defined by their historical strengths or major acquisitions, directly explain their current revenue mix and ultimately why the market values them so differently.
So let's start with the valuation leader we identified earlier, CME Group. CME, the derivatives powerhouse.
Right. CME's dominance really rests on being the undisputed source of truth for critical global benchmarks. Think SOFR interest rate futures, the old Eurodollar contracts, which are still significant, E-mini S&P 500 futures. These are fundamental tools.
And their financial structure reflects that focus, right? Highly concentrated.
Very much so. Approximately 85% of their total revenue is derived directly from those high-margin trading and clearing fees on their derivatives products. Their strategy is laser-focused on product innovation within that derivative space and maintaining market exclusivity wherever possible. A great example is them extending their crucial license for NASDAQ 100 futures all the way out through 2039. They dominate these critical, mandatory risk management tools.
Okay, CME Howard derivatives dominance. Next up, Intercontinental Exchange, ICE. They own the NYSE, the icon, but you described them differently. More about diversification through acquisition.
Yes, ICE is best understood as the diversified acquirer. While they operate the iconic NYSE and also have leading positions in energy derivatives, like Brent crude futures, their defining strategy over the last decade or two has been aggressive and largely successful M&A. And importantly, that M&A is focused on diversifying outside the traditional exchange transaction model.
Like what?
Well, they've built up a really commanding presence in the U.S. residential mortgage technology space, covering servicing, origination software, data, and analytics for the mortgage market. They also offer comprehensive fixed-income data services, competing with Bloomberg there, too.
So their revenue mix is more of a blend, then, compared to CME?
It is. It's much more balanced. Roughly 50% comes from trading and clearing across equities, energy, etc. But a very robust 35% now comes from data and analytics, including that mortgage tech and fixed income data. Their aggressive diversification makes them significantly less reliant on the pure volume of exchange trading day-to-day compared to CME.
Okay, moving across the pond to London Stock Exchange Group, LSEG, we have to reiterate, after the Refinitiv deal, they are the data and analytics giant.
Absolutely. Their entire identity, their entire investment case now is defined by that massive $27 billion Refinitiv acquisition. As a result, LSEG's revenue profile is skewed very heavily towards data. Yeah. Somewhere around 70% of their revenue now comes from the data and analytics segment.
70%, wow.
Yeah. Their current strategy is all about intense integration efforts, realizing the cost and revenue synergies from that huge deal. And their big strategic partnership with Microsoft, focusing on AI-powered analytics and cloud distribution, shows they are betting their entire future on becoming a tech-driven data provider. Plus, don't forget, they own the highly valuable FTSE Russell Index franchise, which just prints immense, high-margin recurring licensing fees year after year.
That transition is just profound. Okay, now NASDAQ and DAQ, often just seen as the home market for big tech listings. But you mentioned they have an interesting counter-strategy, positioning themselves as a technology vendor.
Yes. NASDAQ is really the technology leader among the group. While they do, of course, manage the second largest U.S. equity market, known for all those tech listings, a huge part of their strategy and their story to investors is positioning themselves as a technology provider to the broader financial industry globally.
How does that work?
They sell their own sophisticated trading platforms, surveillance software, clearing systems, and other market technology to over 130 other marketplaces, regulators, and financial institutions around the world.
So their tech is powering other parts of the financial system.
Exactly. And their revenue reflects this diversification. Only about 25% comes from traditional trading fees. Roughly 35% is from data and analytics, similar to ICE. And a substantial 25% comes directly from these technology services, including newer software-as-a-service offerings like their anti-financial crime platform, Verafin, which they acquired. They've effectively weaponized their internal technology expertise into a major external business line.
A very different model. Now, turning to continental Europe, Deutsche Börse, DB1, they employ a different kind of organizational model, right? Deep vertical integration.
That's the key for Deutsche Börse. The vertically integrated European leader, they control the whole value chain in many respects within their core markets. They own the ETRA electronic trading platform, the Eurex derivatives exchange, a major competitor to CME in some areas, and crucially, Clearstream, which is a massive international central securities depository providing clearing, settlement, and custody services across Europe and beyond.
So they touch the security at multiple points in its life cycle.
Exactly. Their strategy, which they call Horizon 2026, is explicitly designed to leverage this deep vertical integration to capture revenue at every single point of a securities life cycle, from the initial trade execution on ETRA or Eurex, through the clearing and settlement process at Clearstream, and even into long-term custody. Their revenue breakdown reflects this integrated model. Roughly 45% from trading across equities and derivatives, about 25% from data analytics, and another 25% from technology and other services, including that vital post-trade infrastructure.
Okay, integrated European leader. And finally, let's talk about Hong Kong Exchanges and Clearing, HKEX. They have a very unique geographical advantage, don't they?
Completely unique. HKEX is quite simply the gateway to China. Their strategic position is unlike any other major exchange operator globally. They serve as the primary international conduit for accessing mainland China's vast capital markets, primarily through the hugely important Stock Connect and Bond Connect programs,
which allow international investors regulated access into Shanghai and Shenzhen and vice versa.
Precisely. As a result, HKEX's financial performance is, by necessity, highly correlated with capital flows into and out of China, and also very sensitive to regulatory decisions made in Beijing regarding market access. Because they are the primary gateway, their revenue profile remains, perhaps unsurprisingly, highly reliant on trading and transaction volumes. Around 65% of their revenue still comes from trading and clearing fees generated by that unique access. They also, interestingly, own the London Metal Exchange, LME, a global leader in industrial metals trading.
Okay, that's a fantastic overview of how distinct their strategies really are. It totally sets the stage for the financial analysis. Where is the growth actually coming from for these companies? And maybe more importantly, how stable or reliable is that growth?
Yeah, we can broadly categorize their growth history into two main paths. First, you have the clear M&A-driven growth stories. LSEG, obviously heavily influenced by that massive Refinitiv deal, recorded a staggering 21.9% five-year compound annual growth rate, C grade, for revenue. ICE, also a very active acquirer, shows a strong 12.5% revenue CGR over the same period. These impressive numbers clearly reflect successful deal-making and integration, at least on the top line.
Okay, so M&A is one path. What's the other? Organic growth.
Exactly. The prime example there is CME Group. They show a solid 8.1% revenue CGR over 5 years, but perhaps more impressively and even stronger, 11.5% net income CGR. And that growth has been driven almost entirely by the increasing depth, breadth, and volume within its core derivatives franchise. New products, more users, global adoption. This really highlights the incredible power of their high operating leverage that we talked about earlier.
Right. Can you just restate the importance of that operating leverage concept again, maybe in simple terms for an investor? Why does it matter so much here?
Sure. Think of it this way. An exchange needs the same incredibly expensive, massive technological infrastructure, whether it processes, say, 1 million trades a day or 10 million trades a day. That huge technology and infrastructure budget, it's largely a fixed cost. It doesn't scale directly with volume.
Okay.
So when trade volumes do increase, or when data subscriptions rise, essentially, when incremental revenue is added on top, the costs don't rise proportionally. Therefore, that new extra revenue flows at extremely high margins directly down to the bottom line to profit.
Got it.
This is why CME, with its highly specialized high-volume derivatives model, consistently maintains such impressive EBITDA margins compared to some of the more diversified players.
These are clearly very cash-generative businesses, but they also need to be assessed on how well they allocate that capital, right? And how they return it to shareholders.
Absolutely. Capital allocation, especially around M&A, is arguably the biggest determinant of long-term success or failure in this sector. ICE is consistently praised by analysts for its successful integrations over the years, including absorbing the NYSE effectively. TMX Group up in Canada, their integration of the energy trading platform Trayport's another good example. Its revenue more than doubled since the 2017 acquisition, showing value creation. But the risks of getting M&A wrong are absolutely immense. Just look at HKX's failed, unsolicited $32 billion bid for LSEG back in 2019. If that had somehow succeeded at that price point, it could have been a truly catastrophic misallocation of capital for HKX shareholders. Huge risk.
And for shareholders who aren't betting on huge M&A deals, how do they get returns? Dividends, buybacks?
Yes, they are generally very reliable payers of capital back to shareholders. You see consistent, often growing dividends. TMX Group, for instance, increased theirs by 10% in July 2025. And you also see significant share buyback programs, which help support earnings per share growth. LSEG, for example, announced their intention for up to £1 billion in buybacks in the second half of 2025, which signals management's confidence in the cash flow stability post-Refinitiv integration.
Okay, so M&A success is key. To truly evaluate management quality, especially after big deals, you argue we need to look past simple net income or even ROE and focus on returns on capital.
Yes, the crucial metric here, especially for serial acquirers like IC and LSEG, is return on invested capital, ROIC. It is the definitive quality check for M&A effectiveness, in my view. ROIC measures whether the returns generated by the company's entire capital base, that includes the equity plus all the debt they took on for acquisitions, and also the subsequent accounting goodwill created on the balance sheet, whether those returns actually exceed the company's underlying cost of capital. Simple return on equity, ROE, only looks at the equity portion, which can be misleading after debt-fueled deals.
Why is ROIC so particularly important in this sector with these specific companies?
Because LSEG and IC especially have grown significantly through large acquisitions. If management consistently pays too much for those acquisitions, even if the top-line revenue grows impressively, the ROIC will likely decline over time. Why? because the returns generated aren't actually justifying the massive total investment made, debt plus equity plus goodwill. A stable or ideally a rising ROIC over time confirms that the deals are genuinely value created for all capital providers. A declining ROIC, however, is a major red flag. It suggests the economic moat might actually be getting eroded by overspending on acquisitions. So you might see, for example, Deutsche Börse reporting a strong headline ROE around 20%, which looks great. But the ROIC needs to be assessed carefully against their own history of acquisitions to see if they truly earn that return on the total capital invested.
Okay, that's a critical lens. So, using that framework, how do the actual valuations as of October 2025 reflect the market's assessment of these different strategies, risks, and maybe their capital allocation track records?
You see a pretty clear division in the market's view, reflected in the multiples. First, you have the premium players, the companies commanding high valuation multiples, usually due to their perceived stability, unique growth vectors, or market dominance. HKEX is the prime example. It trades at a very high price-to-earnings PE ratio of around 35.9x. That's a massive premium. It reflects a direct market bet on its unique, exclusive status as the critical gateway to future China capital market liberalization and growth.
That's almost a political bet as much as a financial one on the company itself.
It absolutely has a large geopolitical component, yes. Similarly, NASDAQ, with its successful pivot towards technology and SaaS, trades at a premium enterprise value to EBITDA, multiple of 22.1x. And CME, for its indispensable derivatives dominance and high margins, commands a strong 19.0x EBITDA. The market clearly views these more specialized, defensible models as highly predictable and worth paying up for.
Okay, so those are the premiums. Where is the market showing skepticism then? Where's the notable discount relative to peers?
That falls squarely right now on LSEG. They trade at a noticeably lower multiple compared to those premium players. Specifically, an EV/EBITDA of around 11.3x and a PE of about 19.0x.
That's a significant gap, especially on EV/EBITDA.
It is, and it's a crucial financial signal. It tells us that despite the massive revenue uplift LSEG got from the Refinitiv deal, the market is still signaling significant concern about the execution risk. Investors seem to be waiting for more conclusive proof that the promised synergies will fully materialize, that the complex integration is truly complete and working smoothly, and crucially, that the ROIC will eventually justify that massive $27 billion price tag. Only then might the market award LSEG the higher multiples given to peers like CME and NASDAQ. The discount reflects that show-me stance.
That makes perfect sense. And it's also worth noting quickly that valuations across the whole sector tend to expand not just during periods of high volatility, as we established, but also during periods of rising interest rates.
Absolutely. Rising rates actually benefit these operators in two key ways. First, as we discussed, higher or more uncertain rates tend to drive more hedging activity in their crucial interest rate derivative segments, more volume. And second, these exchanges, and especially their clearinghouses, hold vast amounts of collateral cash and securities posted by market participants as margin. They earn net interest income on this collateral. So higher prevailing interest rates mean higher, essentially guaranteed, returns on that huge pool of collateral. It acts as another profitable, predictable revenue stream that expands when rates go up.
Fascinating. This has been a really insightful deep dive into what really is the core infrastructure of global finance. So just to summarize our key takeaways for everyone listening, we've established these companies are essential oligopolistic gatekeepers. They have incredibly strong economic moats, fundamentally driven by those powerful network effects and significant regulatory barriers.
And we've clearly seen the critical transformation that's underway across the sector. They are fundamentally transitioning their revenue base away from volatile transaction volumes and towards high-margin, recurring data and technology revenue. That's the direction of travel, and the market generally rewards it.
Right. And the valuation premiums assigned to individual players seem to be tied directly to the perceived stability and defensibility of their primary growth vector, whether that's CME's derivatives dominance, NASDAQ's successful tech pivot, or HKEX's unique gateway access to China.
They really are high-quality, essential businesses that represent mandatory infrastructure for the global economy, which is exactly why they warrant such detailed scrutiny from investors.
Which brings us perfectly to our final provocative thought for you, the listener, to mull over. The strategic shift towards becoming more like a data utility is clear, and the market obviously values that stability highly. But our financial analysis today really highlights that M&A execution, getting those big deals right and integrating them effectively, is perhaps the greatest determinant of future success, maybe even more so than just day-to-day operational excellence. The persistent valuation discount on LSEG strongly suggests the market hasn't fully bought into the Refinitiv story just yet. So the question you really need to consider looking ahead is this. Can the exchange sector truly complete its transformation into being viewed as high-growth fintech data companies and consistently deliver the high returns on capital needed to justify that view? Or will the persistent risk of overpaying for data assets, chasing that stability at potentially any price, eventually start to erode the powerful structural economic moats that have served them so well for so long?
That's the key tension. The success or failure of these multi-billion-dollar integrations, like Refinitiv for LSEG, will ultimately determine whether these powerful gatekeepers can maintain their premium status for the next generation of investors, or if they risk destroying value through overly ambitious M&A.
A truly critical analysis of the companies that literally make the financial world turn. Thank you so much for guiding us through this deep dive today.
My pleasure. Always fascinating to look under the hood of these businesses.